Hey guys, and welcome back to the channel. I'm your host, Rebecca Young from 5 to 9 Real Estate, and today's topic I'll be covering when there's a situation where you don't want to buy on cash flow. So in this case, I'll be walking through an actual example of a property that a client purchased, and I hope that you guys enjoy. If this is the kind of content that you would like to see, please go ahead and like the video, subscribe to the channel, and leave any comments below in terms of questions that you still have, ideas for future topics. I really appreciate the engagement, and it helps me make sure that I'm staying relevant and providing valuable content to my viewers. So thank you again, as always, for that. So with this, I'm gonna go ahead and jump into this. I'm gonna do this as a demo setup again, where I'm gonna walk through the spreadsheet that I had done previously for another example. And in this case, just to set some context, this purchase was actually a condo in Toronto. So for a lot of you, you probably know that the Toronto condo market has softened quite a bit this year, partially because of Airbnbs and short-term rentals being put on the market as long-term rentals, people leaving the city, leaving condos and wanting to get more space outside of the city. And basically when people can't rent out those properties, they are now turning them over to be sold. So because of this, it has thrown off the supply and demand in Toronto, and a lot of people are worried about this, and they think that this is a bad sign to invest in the Toronto condo market. I actually want to challenge that, because the way that I look at this as a seasoned investor for doing this for 9 years now is that I see a very valuable area, a very typically high in demand area that is actually on sale. Everything's discounted right now. So I would like to compare it to when the stock market crashed in March of 2020. We saw the same thing where there were different factors, but a big portion of what caused the dip is that people got scared holding on to these stocks and decided to sell. And what I've seen over the years is that typically you want to do the opposite of what other people are doing. Of course, analyze the data and make sure you understand the reasons why. But if you see an opportunity, I think you should jump on it. That's what I've done in the past, and that's worked out well for me after doing my due diligence and my research. So in this particular case, I see the same thing in Toronto, and especially in condos right now, because a lot of people don't want to be in shoeboxes in the sky and for high prices. So the thing is that right now, it's on discount because there's more supply, people have had other options, people have left the city. So now we are seeing downward pressure on purchase prices as well, and the buyers have more negotiating power. I personally don't think that this is going to stay forever. I don't see a situation where Toronto doesn't come back. I have commuted, now I live in Toronto. Being on the other side of that, where something that should have taken me a 30-minute drive to get to work actually took me typically an hour and a half to get to work, didn't make it worth it for that difference in price, especially when the outside markets are now catching up to Toronto pricing as well. So the way that I look at the Toronto market is that I want to be conservative, right? So I've given myself a couple of years to account for this, but at the end of the day, I do believe the Toronto market is going to come back, and actually stronger than before, because if we all have to come back to work and people are deciding that they don't want to do that commute and that they want to live in Toronto again, we're going to have the same problem as before with demand and supply. It's going to be, reverted back to how it was before the pandemic. And I think it's going to be even worse, because then you're going to have so many more people scrambling to try to get back into the city. So I just wanted to set this context for this example that I'm going to go through. But at the end of the example, I'm going to show you that I believe that the Toronto market is going to come back in 2 years, to be conservative. And I just want to explain that before I show you the numbers. So let's go ahead and jump into this. So I'll do the same thing as I've done for a couple of videos, where I'm screen sharing and actually walking you through the example. Like I mentioned before, I actually got this condensed pro forma in my Excel from a realtor that I partner with. So thank you again, Paulo, for that. So in this particular example, these particular types of properties, 1-bedroom condo, 1 washroom, in this particular area of Toronto was typically going for around $530 last year. So for my client, I was able to scoop this up for $420. And in this particular case, this client was basically evaluating between, continuing to rent or purchasing their first home. So, and the reason why this is a little bit of a of a taboo video is because I'm always preaching about cash flow. Typically, I would recommend that if you're gonna live in an expensive area, that you wanna find a way to make money from where you're living. Anytime you own real estate, you wanna find a way to make money from it as well. So typically, I like to recommend that you try to get into a duplex if you're gonna live in Toronto. But of course, it's a higher price. And so I wouldn't let that limit you from getting into the real estate market, because it's gonna get harder to get into the market in the future. So usually the two options that I suggest to clients so that you can focus on cash flow is that you either get a place that you can rent out a part of it and that you're living in personally, or if you can't afford to do that in Toronto, then I would recommend to look outside of Toronto that I can also help with and find a property based on cash flow. So I just wanted to set that context, because this is going to be a incomplete disagreement to what I always say about always buying on cash flow. But I have a really strong reason for that. So let's go through the example, and then I'm sure that'll become clear in time. So let's start off with the cost of acquisition. And from the purchase price, in this particular case, because it's less than $500,000 and because the purchaser qualified for this, they were able to put in a down payment of 5%. Now, because it's not the 20% that the lenders typically want to see, CMHC did apply in this case, and I did cover a couple other videos explaining this, so I'll make sure there's a link in the video to reference back to if needed. So in this particular case, we started off with a mortgage of $399,000. Now, when you have to add back the mortgage default insurance premium at that time. So again, it eats into your initial equity. This is a reason why real estate is a long-term goal and a long-term investment. So that means that this client is starting off with an actual total mortgage of $414,960. So just keep that in mind, because we're going to have to reference that in our ROI later on as well. So just starting off with our cost of acquisition, the down payment in this case was only 5%. So 5% of 420,000 is 21,000. And then in this case, the land transfer tax, because this was our first time buyer, was only $1,275 out of pocket. Legal, I'm estimating at about $1,000. And I have the exact amount for the home inspection report. That was exactly $479.12. That included a couple of reports and HST on top of that. So this particular client is all in on the property for $23,754.12. Now let's go into the cash flow portion. Obviously, there's going to be some differences compared to my last example of analyzing a rental property, because for this particular property, the client is actually going to be living there. So it's not an investment. That's why they were able to put down less than 20%. So when I look at the monthly expenses, basically, obviously there's no rent in this case. And then from there, the mortgage was actually provided from the lender. So this client went to a mortgage broker in advance, found out what they would pre-qualify for. So I was just working with these numbers in the Excel spreadsheet. So in this particular case, this client got a rate of 1.89% and with a 25-year amortization. So this number is just a given. The property tax is from the listing. So the property tax is $135.93 per month. And the maintenance fees were a little on the higher side. There's a reason for this that I'm gonna tell you about in a minute. So the maintenance fees per month are $472.73. And from there, the home insurance estimate is about $100 per month. Now you'll notice that I don't include anything for utilities. The reason being is because the maintenance fee actually includes utilities. So this is a nice to have because it's just a more consolidated view in terms of expenses. They don't have separate bills in this case. So it was also part of the reason for wanting to pay a higher maintenance fee for this purchase price. Now again, the repairs and maintenance and the vacancy 2% that I usually put to the side every month doesn't count in this case because this property is not being rented. The client is actually living there themselves. So this brings us to, a monthly expense of $2,443.87. So obviously this is a little bit different than how we would typically analyze these numbers. So the last piece is that obviously, if you're looking at this from an investment standpoint, you're looking at this thinking that, it's a personal residence, but it's, if you're also looking at it as an investment, you're looking at this thinking, $2,400 out of pocket every month, that seems like a really big expense. So let's break this down further and figure out how we're actually calculating the ROI on this. So in this case, what we're doing is, like I mentioned at the beginning of the video, I'm starting off actually at year 2 already, because that's when I'm estimating that the market will be back in Toronto. So because the property values last year before the pandemic in this area for this type of property were $530,000, I'm starting off there as where I think we're going to come back in year 2. And then from there, I put in an appreciation of 4% on that value for the next 3 years. So this is how I was able to extrapolate this out over the 5 years, take the summation over here. So the summation after 5 years is $176,177.92. And then from there, we also capture the principal pay down from the mortgage as well, that you can either get from your mortgage broker, or I'm also going to cover a video on explaining mortgages and what the amortization schedule means. So stay tuned for that. And the annual cash flow in this case is obviously a big negative, because this person is not renting out any part of this property. They're going to be living there solely themselves. So it's a big expense out of pocket. But when I take all these numbers together, this client still comes out ahead within 5 years. So the client will still make an estimate of $97,707.39. But the key thing that I really want to point out here is that you have to compare this for this person's situation. They're comparing between renting or buying their first home. So in that case, this person still has to live somewhere. And in terms of clients that are still evaluating if they want to keep renting or if they want to buy, this is my big argument for you, and this is really crucial to evaluate the difference in your financial future, basically. So I'm just going to pull this screen over. Sorry that was cut off, but basically, in the example of this client purchasing this home, they will be up within 5 years of approximately $98,000, regardless of paying for all these expenses of approximately $2,400 per month. Now, because the market is also softened in Toronto, they could very easily get a place for about $2,000 a month if they were looking to rent. But if we look at the difference between the 5-year returns, obviously if you're just renting and you're not working towards anything, and if you're not renting out a part of that home, then you're not reclaiming any of that lost money. It's just a sunk cost. So if you're renting at $2,000 over 5 years, you've actually lost $120,000. Versus in the situation where this client has purchased this home, despite being out of pocket even a little bit more per month, they will actually have, within 5 years, they will have $228,379.59 of available equity in the property between the appreciation of the market and the mortgage pay down as well, despite actually being out of pocket and paying out of pocket $2,400 per month. So as you can see, when I look at the total 5-year gain compared to what they put in for their initial investment, so their initial investment again was $23,754.12. The gain within 5 years, so looking at the market coming back and the mortgage pay down, but then also paying the $2,400 out of pocket every month for the next 5 years, it still gives them a gain of $97,707.39, which actually gives them a return on investment of 411%. So that's an incredible return. And it's the same thing in terms of if people are looking to get their first investment property in Toronto, the numbers are going to change slightly because their initial investment is going to be larger because of the 20% down payment, but you're still seeing unbelievable returns. And that's why I strongly recommend that you consider Toronto as an option and the condo market, despite a lot of people being afraid of that right now because it's on a downward trend. Like I mentioned, these are key properties. This is a key area, not even just in the country, but in the world. A lot of people want to immigrate and move specifically to Toronto. So this is an area that's still going to be in incredible demand in the future as well. And I really believe that there's an opportunity here. If anybody has any questions about this, or if they'd like to reach out, I'll leave my contact information below. In terms of any feedback that anybody has on the video, in terms of any questions that you might still have, ideas for future videos that I can cover for you, please leave some feedback below the video. I do review the comments. If you appreciated seeing this type of video and me walking through some actual data and an actual example, please go ahead and like the video. Please subscribe to the channel. It helps me understand which type of content is most valuable for the viewers. So I really appreciate the engagement as always. And with that, thank you so much for your time today. Hope that you found the video helpful. And until next time, take care, guys.